So for example, we say that when you are planning for the audit, you'll have to come up with what we call an audit strategy. You'll come up with an audit strategy. Then also you'll be able to come up with what we call an audit plan. So under the audit strategy, we say that you should be able to define out the scope. So the scope of the work that you're actually going to do as an auditor. So this simply means you have to look at, for example, the amount of work that is actually going to be involved in this kind of an assignment. Also, you have to ensure you look at what we are calling the timing, and of course also what we call direction. Direction. So under scope, we said, for example, you exactly determine establish the scale of the assignment. For example, in this case, if it is an organization, how big is it? So which kind of work is likely to be involved in this kind of work? The timings. So which kind of deadlines are you supposed to be able to meet? You should be able to outline them out. Then direction, how will you be able to direct or actually guide the team that will be carrying out the audit assignment? Then you'll have to come up with what we call an audit plan. So an audit plan, we say now in this case, goes to the detail as to what will actually be exactly happening during the audit, as to what will actually exactly be happening during the audit. So it basically goes to each and every step of the audit. For example, define the audit procedures that will be involved in having to carry out the audit. So it details about exactly what this person will actually be doing, where will he be exactly, at what time. So it is actually able to give out the details as to what will likely be happening for each and every maybe team member on the audit assignment. So how the supervision will likely be carried out. The plan in this case should actually also be done, what should be documented down as to what will likely be happening under each and every step. Then it should be as flexible as possible. In case of any unforeseen emergencies, you can always be able to continue with the plan, because in this case, you have what you are calling stopgap measures to be able to, for example, replace someone who's not actually able to continue with the assignment, So there are two key things here. We are saying audit strategy is of so much importance. Also, an audit plan is actually of so much importance. Also, we touched on something that we said during the planning of the audit, we'll have to carry out something we call risk assessment. Assess which kind of risks you are likely to come across during the audit process. So risk assessment is of so much importance to you as an auditor. For example, we said you'll be able to look at what we call the audit risk, and also assess what you are calling the business risk. Assess the audit risk and also assess what you are calling business risk. So how can you be able to assess risk? How can you be able to assess risk of this client of yours you're going to carry out an audit on? You said, for example, you can be able to look into the industry under which this particular client is actually operating. Also look at the regulatory framework under which this client is actually operating. Has he met all the requirements, for example, in terms of licensing, for him to be able to continue to carry out the business? Which kind of risks are actually associated, for example, in that industry the client is actually operating in? For example, we clearly mentioned, if it is in the banking sector, it is a high-risk industry for this kind of company that are actually operating there. It is a high-risk industry because these people are dealing with money for their clients. So they need to ensure this particular money is always safeguarded, because if they do any kind of mess, simply means that it can end up having to lead such kind of organizations or banks having to go under with the client money. So it can be able to dent their reputation. So the industry under which the client is operating in, the regulatory framework can also be able to tell you which kind of risk that this particular client is actually likely to be having. Then you can also be able to look at the nature of the entity and the accounting policies that have been deployed, the nature of the entity and the accounting policies that have been deployed by the client, and having to do maybe prepare their books of accounts. So when you talk about the nature here, we are looking at the governance structure. So how complex or how simple is the governance structure? So if it is maybe complex somehow, and maybe the organization is just very small organization, then the likelihood of risks of maybe some related party transactions which are not actually basically being declared. So look at also the strategies and the related business risks. In this case, we are talking about, for example, compliance risk. talking about, for example, financial risks amongst other risks. So those are part of the things you can be able to look into if you are going to try and actually assess what some of the risks that this particular client of yours is likely to face while you are likely to face while carrying out the audit on the client. So if those particular factors are put into the into account, then you can be able to discover the kind of risks that are usually involved. Then you'll also have to understand what we call the controls that are usually involved in having to, for example, carry out the processes of the client business operations, So once you do that, then in this case, you can be able to assess or actually unravel some of the risks that you're likely to face as an auditor. So what are the procedures you can be able to use? You can do inquiries. You can just inquire by asking around from the management. So with that, you can be able to discover some of the risks. You can carry out what we call analytical review procedures. You can also be able to just do what we call observation. You can also be able to do what we call inspection. So those particular methodologies can actually simply be used to do what? Unravel some of the risks or carry out what we are calling risk assessment during the planning stage. So I want us to pick up from where we are going to be able to relate business risk and the risk of material misstatement in the financial statements, or how we can be able to relate what we are calling business risk and audit risk, how we can be able to relate what we are calling business risk and audit risk. Then later on, we'll be able to look into as to how you can actually be able to approach your work. For example, if the client, it is the first time you're actually auditing the client, do you approach such kind of work? How do you approach such kind of work? So you can be able to see as to how you can be able to relate what you are calling business risk with what you are calling audit risk. So audit risk, we had covered it briefly in our previous class, but of course now we are going to see as to how you can be able to relate the two in having to carry out what you are calling risk assessment on the client business operations before you can be able to commence your audit. So hope you can be able to see my screen there. Just a minute as you look at the screen there. Yes, welcome back. So welcome back. So we are going to look at how you can be able to relate what you are calling business risk and the risk of material misstatement in the financial statements, risk of material misstatement in the financial statements. So when you talk about business risk here, so business risk, part of the business risk or these business risks, they likely arise from the side of the client, and basically they arise from the processes that are normally carried out by the client. So business risk is a risk model, is not a replacement for the traditional audit risk model, but rather a vehicle or a mechanism for the identification of audit risk, recognizing that most business risk will eventually have financial consequences and therefore an effect on the financial statements. So the business risk places the auditor in the shoes of the management and therefore provides deeper insight into the operations of the business and generates extensive business understanding. So these particular business risks are actually going to arise from what we are calling the client business operations. When you talk about business risk, then part of the examples here, we are talking about what? Financial risk. So these are the components of business risk. These are the components of business risk. So the client business side, they can be broken down into three. We can have financial risk, compliance risk, operational risk. So when you're actually able to understand this kind of risk that are actually being faced by the client, then of course it will be able to also assist you understand more about what you're calling what? The audit risk, or some of the audit risks that you're likely to face as an auditor. So the components of business risk, what are they? It is financial risk, compliance risk, and operational risk. When you talk about financial risk, is risk arising from the financial activities or financial consequences of an operation. For example, you can be able to say maybe inability to be able to meet obligations as and when they actually fall due. So that is a financial risk that this particular business client is actually facing. So when the loan has actually fallen due by the end of the month, they're not actually able to pay. They have defaulted to pay for like maybe the last 2 or 3 months. So they are basically in arrears in terms of, for example, having to pay salary. So that is basically simply meaning there's actually a financial risk. So there's actually also what you are calling compliance risk. So there are those part of regulations that this particular client business operation is supposed to be able to comply with, but they haven't complied. So that is a risk that this particular client is actually facing. So if, for example, it hasn't complied with the relevant licensing, as we are saying in our previous class, then maybe in this case, the business can actually be shut down. So that is a risk that they're actually facing. They are not actually able to comply with the relevant rules and regulations or laws and regulations. Operational risk arising with regard to what? The operations. So the process that have been able to put in place in terms of having to carry out business operations, they're not actually quite effective. They're not actually quite effective. So they are ending up maybe having to incur maybe losses out of the processes due to maybe damages or maybe parts of the raw materials. So some of the processes are not actually basically being complied by those who are supposed to implement them. So they're actually facing what we are calling what? An operational risk. So if you actually combine all these, they lead to what we are calling what? Business risk. So the components of business risk is what? Financial risk, compliance risk, and of course what you are calling what? Operational risk. So these risks, it is important you as an auditor, you understand them. So of course, in this case, we are saying you'll be able to face them at the client place when you are carrying out your audit. And of course, they can be able to give you or actually enable you also to be able to understand further what you had already learned previously, what you are calling the audit risk. So that's where you are saying that it is not actually basically fully a replacement of the audit risk. In this case, just basically a vehicle or a mechanism that can be able to enable you to be able to do what? Identify audit risk. So business risk, you can be able to define it as what? That business risk is a risk resulting from significant conditions, events, circumstances, actions, or inactions which could adversely affect an entity's ability to achieve its objectives and execute its strategies. What we've just been able to try to mention, it has defaulted in terms of having to pay loans. It is not actually complying with the relevant rules and regulations in terms of, for example, maybe licensing. That is basically, those are conditions within the business client operations which are likely to do what? Affect its ability, for example, to be able to execute its strategies, or from the setting of an inappropriate objectives and strategies. So what about the risk of material misstatement? So it is the risk that the financial statements are materially misstated prior to the audit. That is the risk of what? Material misstatement. So it comprises of what? Inherent risk and control risk. Inherent risk and control risk. So this is part of what we learned about audit risk, and I think I actually explained it and actually elaborated it more in our previous class. So there are these two major risks that we are looking at. In this case, for you to understand as an auditor, we are saying business risk, you must be able to understand it. When you're carrying out the audit at the business, at the client business operations place, then you need to be able to evaluate what are some of the business risks that this particular client is actually facing. So as to having to understood that, then you can also be able to easily evaluate your audit risk. So the risk that in this case, for you as an auditor, you are likely to express an inappropriate opinion. It is normally contributed to, for example, in this case, if there are high levels of risk of material misstatement. And these risk of material misstatement are usually contributed to by what we call what? Inherent risk and control risk. So audit risk is a summation of what we are calling inherent risk, control risk, plus what you are calling what? Detection risk. So inherent risk is basically those risks that are there that cannot actually basically be maybe controlled by what, even if you put in place effective internal control systems, these risks will basically still actually be in place. Control risk, these are simply risks that in this case, the ICS cannot actually be able to, for example, maybe cannot actually be able to detect. So these ones cannot actually be controlled in any way. They cannot actually be controlled in any way by the internal control processes. There are other risks that are likely not actually basically even to be controlled by what you're calling what? The internal control systems. Control risk, those risks, you have the internal control systems, they're supposed to detect them, but these ICS that you have in place cannot actually really be able to detect them. So they are rising out of what you're calling ineffective internal control systems. So that is what we mean by audit risk, and that is what we mean by what you are calling business risk, what you are calling business risk. So those are the components of audit risk, and of course the components of what you are calling what? Audit risk. So sometimes in the exam they could ask, what are the components of audit risk? It is comprised of inherent risk, control risk, and detection risk. So detection risk, I told you, is basically risk that those audit procedures you put in place, they won't be able to unravel any form of material misstatement. So they are not actually effective audit procedures. So if you have ineffective audit procedures, they won't detect any form of material misstatements. That is a detection risk. It can arise out of what? Having what we are calling poor sampling methods of your evidence. If you sample out your evidence without using proper methodologies, for example, that in this case, considering what you are calling the levels of materiality, then it simply means that those audit procedures won't be able to unravel what you are calling what? Material misstatements. So we said if the control risk and the inherent risk are actually so high, then it simply means that you have to deploy effective audit procedures. So you have to reduce on the detection risk. If these ones are so high, reduce on this one. This one must be so low. It can only be so low if you basically have proper audit procedures. If these ones are too low, if the control risk is actually so low, whereby the internal control systems are actually working quite effectively, then you don't have to sweat a lot. You don't have to put in a lot of procedures of having to unravel material misstatements. You can just put in maybe simple procedures because the internal control systems at the client place are actually working quite effectively. So therefore, in this case, the levels of the risk of material misstatement is very low. There is no chance that in this case, what has been stated in the financial statements is not correct. The reason being, his internal control systems are actually working very effectively, very effectively. The process he has been able to put in place for each and every department in having to, for example, now in this case, report finally to the final statements, they're actually working quite effectively. So that simply means that your risk of material misstatement is actually very, very low. So you can also be able to do what? Just put in simple audit procedures because there is no room or there's actually no chance that there has been any form of misstatement. But if these two are actually very high, these risks are actually very high, the risk of material misstatement is actually very high, then you must be able to reduce really on this one by having to ensure that you put in place effective audit procedures, So the auditor shall perform risk assessment procedures to provide a basis for identification and assessment of risk of material misstatement at the financial statement level and at the assertion level. What do you mean by at the assertion level? The level at which statements are presented as completely true. So these financial statements are usually presented with the assertion that they present a true and fair view. Who prepares them? It is those who are charged with governance. So they prepare them by simply asserting that indeed what is being presented there is actually very correct or is actually completely true. It is now for you as an auditor to be able to do what? Test this truthfulness and maybe discover whether it is not true or maybe it is true, and it will be able to come out where? In your audit report. It will come out in your audit report. So you have to be able to assess the business risk and of course also be able to assess what you're calling what? The risks of material misstatement, or be able to look at your audit risk model, when you're having to approach the audit, So how do you, for example, now in this case, identify business risks? How do you, for example, now in this case, identify business risk? So there's an example that has been used there. So Esteem Club, a hospitality service provider, is a hospitality service provider and runs a chain of clubs. So they run a chain of clubs, one of which is situated in a small town near London. So the club provides restaurant services, bar services, lodging and boarding facilities, and a swimming pool and a recreation facilities such as boating, billiards, tennis cards, and room. It has recently obtained a permission from the state to sell what? Alcohol in its club. So they have gotten that particular licensing to sell alcohol where? In the club. So they are only allowed to sell alcohol in the club. So the business risk and related financial statement risk of this can be, for example, the business risk, the permission to sell alcohol in the club may be misinterpreted as being applicable to all what? Facilities. So remember, this particular hospitality provider has several what? Several facilities. It has a club, it has a lodging, it has different facilities, it has bar services, restaurant services. So, but of course, they have only been allowed what? They have been licensed only to sell this particular alcohol where? In the club. So they cannot be able to sell in the restaurant. So there's a high chance that in this case, they can end up having to do what? Misinterpret and say maybe they can be able to sell alcohol all over the facilities. So the permission to sell alcohol is only in the club and may be misinterpreted as being applicable to all the facilities that the club provides, whereas the company is actually allowed to sell only alcohol in the bar area. So hence there is a risk that the club will face severe penalties from the state since if it sells alcohol in areas that it is not permitted to be able to sell. So in the restaurant, employees may misappropriate food items and indulge in fraud. So if they sell alcohol in the other areas, that will be going against what? The licensing provisions. So they can end up having to be maybe suspended, not to continue to actually operate. So that is a business risk that is actually arising out of what? Non-compliance of the rules and regulations, So the risk of material misstatement in the financial statements, how does it arise? Breach of regulation may require paying a penalty. However, provision relating to breach of regulation may not be met. This means that the profit may be understated. So if there's a breach, if there's a likelihood of breach of having to be able to pay for this particular, to be able to, for example, comply with this particular licensing, then they are going to be penalized. So you can be able to see that failure to be able to comply still is leading to a risk of material misstatement. Reason being, in the financial statements that have been prepared, they haven't provided for the consequences of the penalties. So for you as an auditor, you've already assessed, you've looked at as to how this particular hospitality provider is actually operating. They have been given a license, but of course, they are not actually basically using the license as per the rules and regulations. And that is already what? A business risk. Business risk that is actually arising there is what? Compliance. So they haven't complied with what has been set out as the rules and regulations. But in this case, it is also basically affecting the financial statements. The reason being, there hasn't been any form of provision as to any penalty that can actually arise out of what? This non-compliance of the license that has actually been issued. Because if they don't comply, there'll be a penalty. It simply means that this penalty must actually basically appear in the income statement. So either as a penalty that has already been serviced, or basically in this case has already been paid, or alternatively, as a provision that has to be provided. In any case, the penalty arises, then it will be an obligation that will have to be paid by this particular service provider, hospitality service provider. So in this case, there's a breach of regulation that may require paying a penalty. So of course, if they breach, they pay a penalty. However, there is no provision in this case, for example, in the income statement of that particular penalty. So there's a misstatement. There's a risk of what? Material misstatement in where? In the income statement. So that's basically what you are saying, that you as an auditor, you have to understand the business risk, because in this case, this business risk can actually also be able to do what? Contribute to what you are calling risk of material misstatement. And that's how basically it can actually be able to arise. For example, if you don't comply, that is non-compliance. There's a compliance risk. The compliance risk is under which model? It is under business risk. If you fail to comply, there's a penalty. This penalty, it has to be provided for in the financial statements. If you don't provide for this particular penalty in the financial statements, you have misstated your financial statements. What is actually appearing there, it is not correct. It has been misstated, because it simply means that your income will be overstated. It will be overstated. Reason being, there hasn't been a provision for this particular expense. We are calling what? A penalty in the income statement. So that income statement you are seeing, it is not correct. It is misstated. But this has been contributed to by what? Business risk, that is basically leading to what you are calling a risk of material misstatement due to what? Non-provision of the penalty that is likely to be incurred for having to do what? Fail to comply with the license that has actually been issued for the restaurant service provider. So that is the essence of having to understand business risk when you basically approach the client audit work. And of course, as to how you can be able to connect it to what you are calling what? Audit risk. Because you are saying risk of material misstatement is a component of it, is basically one of the components of what? Audit risk, which you've already explained here. You can be able to see it is just here. You can be able to see we've already been able to explain up here. It is up here. Where is it now? Where is it? It is up here. It is here. Risk of material misstatement. Risk of material misstatement. But we are saying this risk of material misstatement, sometimes it can also be contributed to by business risk. This one, for example, this one has been contributed to by compliance risk. So there was a compliance risk that led to what? A risk of material misstatement due to non-provision of the penalties that are likely to arise out of the non-compliance. The same case, for example, now in this case, if you default on payment of a loan, number one, maybe the person who gave you the loan can be able to penalize you. So that is a financial risk. So non-failure, or basically failure to be able to meet your obligations as and when they actually fall due. That is a financial risk. But at the same case, it can lead to what you are calling also what? Penalties, because they normally put penalties. If you default for the first month, the second month, they put a penalty. So if those penalties are not actually provided for in the financial statements, it simply means that your income statement, in terms of the income, it has what? Been overstated, because you have to provide for the penalties, in this case, arising out of the financial risk. What is the financial risk? Failure to meet your obligations as and when they actually fall due. So that is the essence of having to understand business risk and, of course, audit risk when you're having to approach your work as an auditor, during the planning stage. So there's another concept that is of so much importance to you as an auditor: materiality. So of course, you've been able to analyze risk and as to how you can be able to approach what? Risk. But there's of course also another concept we call what? Materiality. The concept of materiality is applied by the auditor both in planning and performing the audit, and in evaluating the effect of identified misstatements on the audit of uncorrected financial statements. So when you talk about materiality here, we are focusing on the effects. Of the misstatements. On the audit and of uncorrected misstatements. We are focusing on the effect. What is the effect of this particular misstatement? Is it material? So what do you mean by the effect here? For example, the sales are supposed to be, let's say, for example, maybe 2,000. But of course, they have been able to do what? Mistake them by 1 shilling. They have indicated it is 1999. It is 1999. Instead of having to indicate the sales are what? 2,000. So what is the misstatement here? It is 1 shilling. This 1 shilling, is it of so much significance to actually affect, in this case, or maybe make you to be able to modify the audit report? So what is the effect of identified misstatement? That 1 shilling. What is the effect, for example, now in this case, if you don't actually so much consider it in having to, for example, prepare your audit report? So is it of so much importance? Is it so material that in this case, it will end up having to make you, for example, maybe modify your audit report? So that you are saying, you'll be able to evaluate the effect of identified misstatement, that 1 shilling, on the audit and of uncorrected misstatements. So what is the effect on the uncorrected misstatements? If it is so material on the financial statements and informing the opinion in the auditor's report, then you should be able to effect it and be able to capture it in your audit report. If it is so material, it is so important. Let's assume, for example, it was not 1 shilling. Let's say, for example, it was maybe 500 shillings. So 500 shillings out of 2,000, that is quite significant. It is quite significant. So it is so much material. It is really affecting the financial statements. So it is really affecting the financial statements. So each and every items or transactions or balances will have, for example, like a level of percentage under which if they reach a certain level, then you can be able to recognize them as actually being material as an auditor. For example, they've been able to give like a summary here. In order to calculate a level of planning materiality, auditors will often take a range of values and use an average or a weighted average. For example, if you're having to consider an item affecting, for example, profit before tax. So profit before tax, in this case, if that particular misstatement is between a level of maybe 5 to 10%, 5 to 10% there, or is it beyond maybe 10% or beyond maybe 5%, so you'll be able to consider it as actually being so material. So if it is, for example, now in this case, the gross profit, if it is the gross profit, if it is beyond maybe 1%, then you can be able to consider it as actually being so material. If it is on any revenue, then if it is beyond 1% of the revenue, it is so material, so it will be able to affect what you'll be able to present as your audit report. If you are looking at the total assets, if it is beyond maybe 2%, then that is quite serious. It is quite material. You should be able to consider it, for example, in having to prepare your audit report. It can make you to be able to end up having to modify and say these are misstatements because of the total assets. They have been misstated by a percentage of 2 point and excess. So net, if it is considering, for example, the net assets, if it is beyond maybe 5%, then you can be able to consider it as maybe being so significant. So you can be able to look at those different kind of levels for you to consider the materiality of the misstatement, the materiality of the misstatement. And how do you identify materiality? You not only basically look at the value, sometimes you can also be able to look at the nature of the transaction and also the impact it has. So apart from just having to look at the values, you can also be able to consider also these other factors of materiality, even if you are looking at the value. Look at the nature of the transaction, e.g., transactions related to directors, such as remuneration or contracts with the company. They're usually of so much importance that you evaluate them keenly as an auditor. You can also be able to look into it, the levels of materiality, by looking at the value. So land with a value which comprised 3/4 of the asset of the value, it is of so much importance. Impact, so what is, for example, the effect? So a proposed journal which is not material in itself could convert a profit into becoming a loss. So if it converts a profit into becoming a loss, then it becomes material. It becomes material, even if it is within the threshold of having to be recognized as being immaterial. Then if it is basically making a profit to turn to become a negative, then it can be considered to be what? Material. So when you're looking at the levels of importance of transactions or the materiality, then you can look at that, the nature of that particular transaction, look at the value, also look at the impact or the effect or its significance in what is actually being reported. For example, maybe in the income statement. For example, if it is making a profit to become a loss, that is a quite serious impact. So it is significant, it is quite material. So it can actually end up having to make you do what? Maybe modify the audit report. So assessment of materiality or what has been reported in the financial statements or the misstatements in the financial statements, it is of so much importance also to you as an auditor. So you should be able to exercise what you are calling professional judgment in having to determine the levels of materiality of transactions. So a percentage is often applied to choose a chosen benchmark as a starting point in determining materiality for the financial statements as a whole. So that's how basically you can be able to identify what you're calling what materiality, the importance of misstatements, the levels of importance of misstatements. So I can see someone is saying that I hope I'll be able to share this particular notes. In fact, I've already shared, so maybe if you are just new. So this could alpha, this could be your first day. Alpha, this is your first day in class. This could be your first day in class. It's your first day. So I've already shared the notes. So maybe you haven't been able to sit down and try to peruse through them, but these ones I've already shared. So you should be having them. You should be having them. So that's how you can be able to identify the levels of materiality. So the levels of materiality or importance of the transactions and any form of misstatement as to whether it can be able to affect your audit report. You can look at its level of materiality of that particular misstatement. So we had already looked at ways as to how you can be able to identify your risks. We clearly mentioned or predominantly mentioned what we are calling what analytical procedures. And I think clearly explained what are analytical procedures and as to how you can be able to use them to do what? Identify risks during the planning stage. So it simply means the evaluation of financial information through analysis. You analyze through plausible relationship between both financial and non-financial data. So analytical procedures can involve comparisons of financial data, including trend analysis, calculation, and comparison of ratios. You can be able to compare this period and last year, what was basically the performance in terms of ratios. So out of those ratios, you'll be able to discover some kind of trends. You just discover some kind of trends as to what was basically, for example, reported last year and what was reported this year. If you do some kind of ratio analysis, the ratios can be able to tell you a lot, for example, in terms of maybe the performance in terms of the working capital, the performance in terms of maybe profitability. So we have profitability ratios. So the performance in terms of maybe the return on maybe investment, the return on investment. So you can do several ratios comparing period-wise. Maybe it can be month-wise, maybe it can be year-wise. Out of those analyses, then they can be able to tell you some of the areas whereby you see some significant discrepancies that are actually unexpected. So according to your judgment as an auditor, you don't actually expect such kind of maybe discrepancies or variations out of the analysis. So if you see such kind of discrepancies in your analysis, then of course they can be able to tell you which areas you're likely to do what? Focus more on. For example, just what you are saying, that you've realized that maybe in the year 2022, that in terms of having to do what we are calling computer repairs and maintenance, the amount spent was actually maybe 20 million. But in this year 2023, there hasn't been any form of expansion of the company or entity, but they have spent more. They have spent double the amount. So that can be able to raise an eyebrow to you as an auditor. You'll be able to say, probably this could basically be a high level risk area that I need to be able to do what? Maybe focus a lot on it and gather quite more substantive information or evidence to help me be able to do what? Unravel the material misstatements. So analysis is actually of so much importance to help you identify some of the areas that are of so much risk that are of high level risk in the client business operations, So you can deploy it in group audits, for example, in group audits. So you can be able to compare information for prior periods. That is what I'm trying to explain. That's how you do analytical. You carry out analytical procedures. You can maybe carry out anticipated results of the group, such as budgets and forecasts. You can look at the budgets and forecasts. For example, they had budgeted in that particular year from the budget that was prepared in the beginning of the year. They said under the department or in ICT deployment throughout the company, they're going to spend maybe 2 million. But by the end of the year, they had spent 10 million. So what made that particular huge variation in terms of the budget of 8 million? So you've been able to do that analysis. So it raises your eyebrow as an auditor. Then now in this case, we say now in this case, what do? You deploy what you are calling professional skepticism by asking questions from the management. Your budget at the start of the year, you are supposed to spend 2 million in terms of ICT deployment within the organization. How comes by the end of the year you had spent what? Maybe 8 million extra. So they'll be able to start telling you stories, what happened. Then of course we say don't just rely on what they have told you as management. You can be able to gather the evidence also from another party. You do what you are calling having to corroborate, compare the two. So don't just be fooled by the management. So maybe they had made their own deals there. So there was simply ICT equipment that had not been supplied, but they have paid out money. If you, for example, in this case, carry out inspection as whether there exists such kind of equipment in the organization, it is not there. So you try to corroborate that particular evidence you are being given through those explanations from the management with another source. So always auditors don't use just one evidence, especially where they are raising eyebrows or questions. There are a lot of questions to be asked. Don't just rely on evidence from one person. You can be able to ask maybe the management and also ask any other, maybe the internal auditor, if he has any other information. Compare the two evidence, whether what they are telling you is this similar or not similar. If it is not similar, you need to, for example, now in this case, go further. Don't just say, maybe let me just go with what the management has said. So if you corroborate the two, it's not actually basically telling, maybe now in this case, you know how to deploy what you are calling what? Substantive procedures. Try to trace up to the original documentation as to whether there, for example, exists any receipt or any invoice to the company for this equipment that is not actually in existence. So you can also be able to carry out what you're calling expectations of the auditor, or do what you're calling comparable information from what? Competitors. So having to look at what are your expectations and what are you seeing in the client business operations, compare the two. So maybe you have the experience capability, you've audited this kind of clients for the last maybe 10 years. But what you come across in the last 10 years is not what you are seeing. Is not what you are seeing. So probably you know that, for example, in companies operating in such kind of an industry, so they are likely to probably be making sales between maybe 100 million up to 400 million per annum. But you realize that in this case, for the first time, you've come across this particular client who makes thrice what you're actually expecting. So he's actually making 1.2 billion in a year. So this is what you basically are expecting as an auditor due to what may be experience, but what you are seeing there, it is different. So you try to analyze and actually compare from your experience and what you are seeing. So it will be able to make you raise certain eyebrows and simply make you do what? Maybe ask more questions. So that's how basically you carry out analytical procedures. During the planning stage, it can be able to help you unravel or discover areas that are of so much risk or high levels of risk, that are of high levels of risk. So an example, they have given an example as to how analytical procedures help an auditor. An example of how analytical procedures assist auditor is that performing analytical procedures may alert the auditor to a transaction or event of which they were previously unaware, therefore prompting the auditor to investigate the matter, obtain understanding of the matter, and plan appropriate audit procedures to obtain sufficient appropriate evidence. So out of this analysis, you just come across something that is out of the norm or is not actually basically as expected. That's what they're saying here, that in this case, so that's what they're saying, that in this case, it will help you as an auditor to be alert to a transaction. It can be able to make you be alert to transaction or an event which they were previously unaware. So you'll come across other events that you are not actually unaware if you do the analysis. Therefore, analytical procedures are an essential part of developing the audit strategy and the audit plan. The audit strategy and the audit plan. They may also help the auditor to identify the existence of unusual transactions or events such as significant one-off events. Unusual amounts, ratios, and trends might also indicate matters which indicate risk. So that's if you are saying that unusual transactions, instead of having to use 2 million in ICT deployment, they have spent 10 million. That is very unusual. You can't move from 2 million and go to 10 million. Maybe you would expect you can move from 2 million and maybe go up to 2.3 or maybe 2.5. That could be reasonable. But if you go extra 5 times, then that raises questions or raises eyebrows for you as an auditor. So without performing these analytical procedures, then you as an auditor, you'll be unable to identify risk of material misstatement and respond accordingly. So you might not actually be able to discover them and maybe prepare appropriate audit procedures. So you said you can be able to use, when you're carrying out analytical procedures, you can use what you're calling ratios. So of course, you people have already been able to learn about ratios in financial management, especially financial management. So you've already done financial management under intermediate level. You've come across preparation of ratios. So you can have what we are calling profitability ratios. They can give you some kind of trends about, for example, performance in terms of the profits, the operating profit margin. So you can have profitability ratios. They are part of it. That's how you can carry out analytical review procedures. You can have liquidity ratios. So how liquid the company is. Does it have cash? Does it have money to spend? Does it have money to spend? You can calculate current ratios, quick ratios, so they can help you understand the liquidity levels of this particular client. You can carry out gearing ratios, for example, long-term liabilities over equity. Interest cover, so can they be able to meet their long-term obligations? You can carry out what you are calling gearing ratios, tabulate or maybe calculate what you're calling gearing ratios. So what will happen, for example, now in this case, you as an auditor, you are being engaged by a client for the first time. So the most predominant things that should never come, that you should never forget, you must always reach out maybe to the outgoing auditor and maybe find out the reasons as to why he's basically no longer the auditor of this particular client. So what are you supposed to do? Number one, performing procedures regarding the acceptance of the client relationships and the specific audit engagement. Ensure you followed all the procedures to the letter in the client engagement. You've been able to, for example, now in this case, craft the engagement letter. Both of you and the client have been able to sign it out. You've outlined your roles and duties and actually mandates. The client himself has declared to having to, for example, in this case, provide the required information to you. So to be able to carry out the audit, he, of course, for example, now in this case, declares himself as the client, as the one who's responsible for having to do what? Prepare the financial statements. So this one basically should be outlined, for example, in the letter of engagement that you should have signed before you actually accept an assignment for a new client. So in an initial audit engagement, there are several factors which should be considered in addition to the planning procedures which are carried out in every audit. So all these things that we've been able to learn about, audit strategy, audit plan, risk assessment, assessment of levels of materiality. So if it's a new client, you need to, for example, carry out extra procedures. So for example, we are saying you can be able to ensure that you perform what procedures regarding the acceptance of the client. Communicating with the outgoing auditor, reach out to the outgoing auditor with the client permission, ask for information and working papers from the previous audit. For example, the accounting policies, risk assessed, and how they were dealt with by the previous auditor. Review opening balances from the working papers of if you've been given the working papers by the outgoing auditor, what are the opening balances? So what are like those events that are basically carried forward to the current year under which you are supposed to carry out an audit? So if no previous audit, more detailed testing will be needed. Particular care should be taken in planning the audit procedures necessary to obtain sufficient appropriate audit evidence regarding opening balances. So review of opening balances. So much importance. For example, procedures should be performed to determine whether the opening balances reflect the application of appropriate accounting policies. Then consider if the previous audit report was modified affecting this particular current year. So there are those events that could have basically happened in the previous year under audits that are basically overflown to the current year. So you need to understand reasons as to why maybe it was actually modified. Are there even events to be considered under the current year of audit? Consider the accounting policies applied. For example, if they are consistent from the previous year to the current year, or the previous year they used different accounting procedures or maybe policies. So consider matters discussed with the management at the time of appointment. For example, there may have been discussions of significant accounting policies which may impact on the planned audit strategy. The need to develop thorough business understanding. So understanding the client environment or business environment as to how he carries out his business. So this will also be able to assist you in coming up with the audit strategy. Then there's a risk of material misstatement in the opening balances. You have to assess if they are there. Are there any risk of material misstatement in the opening balances carried forward from the previous year before you start your audit? Need to use an experienced team to reduce what? Detection risk. So you need to deploy a very qualified, experienced team to reduce what you're calling what? Detection risk. Whereby you say detection risk, it is the risk that the audit procedures deployed by the auditor won't discover, detect material misstatements. So it is a component of what? It is a component of audit risk. You said audit risk, the components we are having risks of material misstatements, which are two, inherent and control risk, plus what? Also detection risk. So if you put in place or basically send out a team that is actually inexperienced, they don't have the experience of having to carry out such kind of audits, then they won't carry out proper audit procedures. So you can be able to reduce on the risk here by simply being able to ensure they are qualified persons. So you can ensure that your firm has what you are calling quality control procedures in place to use in case of initial engagement. For example, the involvement of another partner or senior individual to review the overall audit strategy prior to commencing significant audit procedures. So quality work for the auditor should actually always be observed. And as we've already emphasized, quality should actually be observed from the time you are being engaged as the auditor throughout the audit process in having to gather the audit evidence up to the end point whereby you're having to prepare the audit report. For example, here you are being actually advised that in this case, you can be able to involve your fellow partner. You can be able to involve your fellow partner to just review the strategy. For example, now in this case, if it is our friend here, Alpha, who has prepared the audit strategy and plan, you can be able to give to your partner. So you are one of the partners. So you're one of the partners in this audit firm of ours. You can be able to give to your fellow partner, who's what? Cecilia Chege. So Cecilia Chege can be able to review. No, ladies are usually very thorough, so she'll be able to review what is actually contained in your audit strategy and tell you this is the most appropriate audit strategy, or maybe it is the most useful strategy you can be able to deploy in having to carry out such kind of. So you'll be able to give his independent opinion. That's how basically you improve on what you're calling quality of your work as an auditor. Even the audit strategy has to, for example, be reviewed by your fellow partner. Know that in this case, you are the only one who prepares with your team. Then you say everything is set. So different people have different experiences. So they can be able to review what you've been able to prepare and giving further guidance or maybe advice as to how you can be able to approach such kind of work. So if it is a new client, then ensure quality by simply being able to do it. If you are the one who has prepared the audit strategy and plan, give it to another fellow or partner in the firm to assist you to be able to do what? Maybe review it, make an improvement on it, or maybe tell you as to how you can be able to go about that particular plan that you are having in place. So compliance with any such procedures should be fully documented, should be fully documented. So that is basically how you can be able to prepare yourself. In any case, for example, this person or this client you're going to carry out an audit on, it is for the first time. That's how you plan yourself. If it is for the first time, having to reach out to the outgoing auditor, checking out on the opening balances in the working papers, having to, for example, now in this case, assess any form of risk of material misstatements in the opening balances, ensuring quality by ensuring that your partner or fellow partner in the audit firm is assisting you to do the reviews, by deploying or sending out staffs who are actually qualified in having to carry out that particular audit, so that in this case you can reduce on what you're calling what? Detection risk. Detection risk. So I can see Alpha is asking, can the level of an auditor affect the review, e.g., experienced auditor work being reviewed by a greenhorn, being reviewed by a greenhorn? So of course, in this case, for example, if you are an auditor, you are an auditor who's basically knowledgeable, experienced, who's carrying out his work objectively, then in this case, for example, even if you have so much experience, probably you'll end up having to look for someone who has maybe more capability or experience than you to be able to review your work. So, and in this case, when you talk about having to review, it is not necessarily that you get someone within the firm. You can even look for someone externally, an external expert. So if you're having to put in place quality control measures, we have someone who can be able to do what you're calling quality control review. That reviewer can be someone within the firm or maybe someone who's actually an expert from outside. So if you're working objectively, you have the knowledge, you're working objectively. In this case, you don't want any form of negligence to be blamed on you as an auditor. Then what do you do in this case? If you are a person who's really experienced, you look probably for someone who's maybe has better experience, has maybe better knowledge in such kind of an assignment to be able to review your work. So you have to look for someone who's more experienced, or maybe you have the same level of experience to assist you in having to carry out that particular review. And not only can you be able to consider someone within the firm, you can decide to look for external expertise to just carry out the review of your work. So we'll be able to look at those persons who can be able to review. When we'll be looking at, finally, we'll be looking at quality control measures during when you're having to prepare an audit report, when you're having to prepare an audit report. So there is what you are saying, that you can be able to assess the risk of material misstatement. We've said risk of material misstatement is contributed to by what? By two risks. The risk of material misstatement is contributed to by what? Two risks. It is contributed to by what we call control risk, which is usually very predominant. Control risk, and what we are calling inherent risk. Inherent risk. Inherent risk. Inherent risk. So when you talk about here, the control risk here, then it's basically touching on the internal control systems that have been put in place by the client. So you can be able to carry out some kind of test of controls. You can carry out some kind of test of control. So the auditor shall design and perform further audit procedures whose nature, timing, and extent are based on and are responsive to the assessed risk of material misstatement at the assertion level. At the assertion level. What they mean by at the assertion level, it is that what has been stated in the financial statements, it is with the belief that it is 100% accurate by those who are charged with governance, because they're the ones who are basically preparing these financial statements. They prepare them with the belief that they're actually 100% accurate. But for you as an auditor, what do you do in this case? You test those assertion levels. Those assertion levels. So these statements are at the level at which those who have prepared them, they believe that they're actually true. But now that is the role that you are there as an auditor to verify as to whether they are actually true. That is the role that you are there as an auditor. They have prepared them with the belief that they are actually 100% true. That's what they mean by at the assertion level. They have been prepared with that particular belief that these particular financial statements are at the level under which they're actually 100% correct or accurate, or they're actually true. But now in this case, for you as an auditor, that's why you've been sent there by the shareholders to test what these people are saying that indeed they are true, whether it is true or not true. That's now, in this case, you have to identify what you are calling what? The misstatements, And for you to identify the misstatements, analyze and check on the risks that are likely to cause these misstatements to happen. If the internal control systems are fake, then high levels of material misstatements are predominantly there at the assertion level, at the final statements. At that level, they are believing that they are actually true. You have to be able to test. You have to be able to test and actually confirm. So the auditor shall design and perform test controls to obtain sufficient appropriate audit evidence as to the operating effectiveness of the relevant controls in the planned business operations. So you can test on the controls whether they're actually working effectively. So you can be able to test on the controls, You can use several measures as well. You can be able to test them. You can be able just to do, for example, inquiries. You can be able to do some kind of inquiries. You can just be able to do, for example, observe what is actually happening. So by simply just observing, you'll be able to tell more about what the controls measures or the internal control systems of the client. So observation, having to carry out, for example, now in this case, interviews, or having to reach out, for example, to the management, reach out to them, get more information from them. So they'll be able to, this will be able to give you more evidence concerning what the internal control systems. So you can also be able to carry out what you are calling substantive procedures, but these ones alone cannot provide sufficient appropriate evidence at the assertion level, So you have what you are calling substantive procedures. Irrespective of the assessed risk of material misstatement, the auditor shall design and perform substantive procedures by having to check on each and every class of transactions, account balances, and their disclosures. So here is whereby now you go deeper and actually identify each and every transaction from the books of original entry. What is their origin? Trace them up to maybe the final statements. Trace them up to the final statements. Trace them up to the final statements. So that's what we are calling what? Substantive procedures. Checking on each and every class of transaction, account balances, and their disclosures. Have they been correctly disclosed? So you can be able to know whether they are correctly disclosed. For example, if you check them from the documents of original entry. So remember, we usually have the documents of original entry that you are relying upon, for example, to finally arrive at what is being reported as transactions in maybe the balance sheet or maybe income statement. So if you are seeing assets, so these assets probably means they are documents of original entity to be relied upon. These assets were acquired probably maybe what? An invoice having to be maybe given to the client. So there were maybe, for example, now in this case, the process that are actually involved there. Maybe there was maybe an LPO like that was actually raised. So you now need to trace back and look at, for example, now the transactions from their documents of original entry. That is carrying out what you are calling substantive procedures. Overall responses to address the assessed risks of material misstatement at the financial statement level may include emphasizing to the engagement team the need to maintain professional skepticism, assigning a more experienced staff or those with special skills, or using experts. So how do you respond to the risks that you've been able to identify? You emphasize to your team that they need to be able to deploy what you are calling professional skepticism, having what you are calling a questioning mind. You are always told that auditors, they ask a lot of questions. So that is basically as to how they are advised, they are supposed to approach their work. So they don't just look at things at the face of it. If they realize there's any form of misstatement, then they need to deploy what they are calling professional skepticism to dig deeper and gather more evidence that can be able to enable them rely upon to prepare an audit report. So if in this case you are in charge of the assignment, advise your team, they deploy professional skepticism if you have realized there are high levels of risk of material misstatement. Also, if you are deploying out this team, then it should be very experienced. It has the experience, capacity, capability, and has the special skills to deliver on such kind of assignment. So providing more supervision will actually also be of so much importance. If you realize there's high levels of risk of material misstatement, so you can be able to do what? Provide more supervision from time to time. Incorporating additional elements of unpredictability in the selection of further audit procedures to be performed. So maybe you can be able to do surprise visits to maybe those ones. Basically, you are maybe gathering evidence from. So making general changes to the nature, timing, or extent of the audit procedures, for example, performing substantive procedures at the end instead of at an interim date. So when the auditor has assessed the business and audit risks relating to the entity and decided on materiality level, he must then decide on the approach of gathering audit evidence. So this basically statement summarizes what we've been able to discuss throughout the start of this particular session. You've been able to assess what is business risk. You've been able to assess what is actually audit risk. You've said that during the planning stage, you as an auditor, you have to understand the business risk. You have to understand the audit risk. And in this case, it will be in relation to that entity you are carrying out an audit on. So once you've been able to identify these particular risks, then you now need to identify their materiality. So, and of course, these risks that you're talking about here, part of the components include what? Risk of material misstatements. These misstatements, how are they significant? These misstatements, are they actually going to affect what you'll be able to present in your audit reports? So if they are quite significant, you should be able to capture them in your audit report, either making you to be able to do what? Maybe modify that particular audit report. So after that, then you can be able to do what? Decide on the approach of as to how you can gather audit evidence. Because during the gathering of the audit evidence is whereby now in this case you deploy the audit procedures. So the levels of risks will help you determine which kind of procedures you can be able to deploy to reduce on what you are calling what? Detection risk. The risk that in this case, the audit procedures you've deployed will not unravel the required evidence to rely upon. So there are various approaches as to how you can be able to gather the audit evidence. You can carry out systems audits. You can use the balance sheet approach. You can use directional testing. You can do what we are calling transaction cycle approach. So these are various approaches you can be able to adapt in having to do what? Gather the audit evidence after having understood the client. After understanding the client, in this case, at the planning stage is when now in this case you go to the next level of what? Trying to do what? Gather the audit evidence. So what is systems audit? So this focuses on the strength or otherwise of the internal control systems. The idea is to perform extensive tests of controls and reduce the level of substantive testing. During planning, the audit firm will ascertain record and evaluate the internal controls. If they judge control risk to be low, the controls will be tested to confirm this. Tests of controls will test the controls are properly designed, exist, and have operated throughout the period. So in this case, when you are carrying out the system audit, you are evaluating the internal control systems as to whether they are actually effective or not effective. So you can be able to test as to whether they are properly designed and they actually exist and they fully operate as per the expectations. You can also be able to carry out what you're calling balance sheet approach. So this is now whereby you trace transactions up to their original documents. You carry out substantive procedures. It will usually be adapted when the control risk is high and controls cannot be relied upon. So if you can't be able to rely on the controls, the internal control systems of the client, then you have no option but use the balance sheet approach, whereby you deploy substantive procedures. Whereby I've told you substantive procedures is whereby now you trace the documentation of what you are seeing in the final statements from the documents of original entry as to how the transaction went through up to how it is actually appearing in the final statements. Remember the income statement, the statement of financial position are the final statements. Before that figure you are seeing in the income statement, there are several things that have actually happened there from the documents of original entry. So you have to trace them back from the invoices from the LPOs that are actually raised, from the goods dispatch notes that are actually there. Those are part of the documentation to be able to put together in having to do what carry out the substantive procedures. The reason being there are high levels of risk of material misstatements. So in this case, it simply means you have to deploy more audit procedures. How do you deploy more audit procedures? Use this particular approach we are calling the substantive approach or the balance sheet approach. So ultimately, the auditor's report contains an opinion on the figures in the financial statements. Therefore, all audits will involve some substantive testing of these balances. Substantive testing involves collecting evidence on the assertions implied in the accounts regarding balances. You can use directional testing. It is based on the principle of double entry bookkeeping. If a trio balance is in balance, there must be a debit entry for every credit entry. So you can be able to, for example, identify the credit entries and identify whether they are corresponding debits. Because in financial accounting, you are actually experts in this. You've already learned about it. For every debit entry, there's actually a corresponding credit entry. If it's a sale, you basically report it as a credit entry in the sales account and report it as a debit entry either in the bank or maybe where? Under cash. So for every debit, there's actually a credit. So you can be able to do like kind of like what? Having to cross-check the corresponding debits and the corresponding credits. So that is what we are calling what? Directional testing. If a debit entry has been overstated, there should be a corresponding credit entry which is overstated. If you realize, for example, in this case, they have overstated the assets. They have overstated the assets. It simply means there is actually a corresponding other account which has actually also been overstated. Maybe it could be bank or maybe it could be cash. If they are overstated now, in this case, for example, motor vehicle repairs and maintenance, it is 20,000 instead of 10,000. It simply means there's actually a corresponding account that probably could actually maybe be overstated. So by cross-checking the debits and actually credits, so you can use that one also to be able to test. So a debit entry has, if it has been overstated, there's actually a corresponding credit entry which is actually also what? Overstated, or another debit entry which is understated. Therefore, a test for overstatement of receivables will provide evidence concerning the overstatement of what? Revenue. If you overstate the receivables, it simply means that your revenue that you've reported should be probably having also been overstated. Then we have transactional cycle approach. So this approach is similar to some ways to the systems audit approach, as it is based on the same transaction cycles. The difference here is that we are not focusing on controls testing, but substantive procedures. Under this approach, transactions that have occurred during the year and result in entries to the income statement are actually what? Tested. So you test the transactions actually affecting the income statement. So you can be able to sample transactions relating to maybe sales. So then you try to actually substantiate with the supporting documentation. For example, looking at the order, invoice, dispatch note. This is what I'm trying to say what will happen during the substantive procedures. You check from the documents of original entry. There was an order that was actually raised. Probably now in this case, you received an order as a company to dispatch what? Goods. An invoice was actually prepared. This invoice was actually accompanied by what? A dispatch note. So what is basically appearing in the order? Is it the same one that was actually invoiced? Is it the same that basically was actually dispatched when basically exiting the company to the client or customer? So now you are trying to trace back to the documents of original entry. What is really appearing there in terms of sales is basically appearing in the documents of original entry as what was reported as the sales of the company. Because for each and every sale, probably you must receive an order from the customer. Then you raise the invoice. Once you raise the invoice, in this case, the goods are maybe picked or removed from the store by the storekeeper. Then in this case, a dispatch note probably could actually be prepared by the dispatch clerk, who basically has to attach the dispatch note together with the invoice to the client, and together with the order that was received from the client. So of course, these ones basically will have like a duplicate that will have to remain at the client business operations. So you check what you are seeing in the order is what you are seeing on the invoice for the same order, what you are seeing on the dispatch note for the same invoice and order. So you are trying to do what shares from the documents of original entry. You are carrying out substantive procedures. The reason being, you've realized that in this case, the risk of material misstatement as to the final figures you are seeing there in the balance sheet or in the income statement, the risks are actually very high. The misstatements are actually very high. They're actually very, very high. And they could be high due to what? Maybe the internal control systems are not actually working. And how are they not actually working? Reason being, in this case, this particular order, you cannot be able to get it. But of course, you are just seeing the invoice. This invoice has not actually basically been signed by the finance manager. The signature of the finance manager is actually missing. The dispatch note was just released with the goods without even having to be signed by the dispatch clerk. The clerk that is actually involved in having to dispatch the goods. So you can see the controls are not actually working. Reason being, clearly they have outlined in their processes or procedures in the client business operations that the order must actually always be attached with the invoice, fully signed by the persons who are preparing these documents. For example, the accountant, the finance manager, they must fully sign one, maybe the order and the invoice. Then when the dispatch clerk is basically dispatching the goods, he has to raise the dispatch note, which he has to sign and maybe be signed by the finance manager and attached together. But that process you are trying to describe, it is not there. It is not working. The internal control system is basically not working as what is actually expected, or as part has basically been drawn down to be done in the client business operations. So this simply means that that figure you are seeing, for example, in terms of the sales to the customers by the end of the year in the income statement could probably be misstated. Reason being, the internal control systems are not actually working as per what has been drawn down or actually expected by the client operations. So that leads to a risk of material misstatement in the final figures. Because if these people are basically not signing off, or they are not basically allowing for these particular transactions that are actually happening throughout the 3 stages to be authorized, for example, by a senior person like a finance manager, then lack of authorization simply means that the internal control systems are not actually working at all. There's a high risk of material misstatement. What you are seeing there in the final statements is likely not to be true. So now in this case, you have to deploy serious audit procedures to reduce on your detection risk, to reduce the chance that you won't unravel these misstatements that have basically been presented there in the financial statements. So you have to do that so that you can be able to ensure transactions are correctly and completely recorded in the financial statements. You can use the transactional cycle approach whereby you deploy substantive audit procedures, So that is what you need to be able to understand in this case. For example, having to identify the risks, and of course, having to carry out the risk assessment. What can you be able to do? Analytical review procedures. And of course, in this case, after you've been able to understand the kind of risks that are being faced by the client, then you can be able to go ahead and actually carry out what you are calling audit evidence gathering, which can be able to enable you to do what? Prepare your audit report. So that's all we can be able to cover for today. So I think we'll wind up with this particular other area, that's how you can be able to deploy technological tools. But of course, this one, you learn more about it in data analytics, business data analytics, but here we just touch on it briefly. So you can be able to apply business data analytics in carrying out or having to evaluate audit evidence. So in business data analytics, you'll be taught as to how you can be able to apply data analytics in auditing, how you can apply data analytics in financial management. I think also how you can be able to apply it in taxation. So here we'll just briefly look at it as how you can be able to apply it where in auditing. So this simply means that you as an auditor, you have to have some kind of like data analysis skills. For example, you can put data on Excel and try to manipulate it, because most obviously in this case, you'll just be looking at figures and trying to evaluate them for any form of material misstatements. So if you don't have data analytics skills, then sometimes in this case, having to evaluate evidence can end up having to be very difficult. So use of technology or technological tools in having to analyze and actually evaluate audit evidence gathered from the client. So that's where we'll be able to pick up from our next class on Wednesday and see how far we can be able to go. But hope up to this particular point, being able to understand that how you can be able to plan your audit as an auditor. Audit strategy, audit plan, risk assessment, assess the levels of materiality of these particular risks that you're actually talking about. And of course, after you've been able to assess them, then now go ahead and basically try to do what? Gather the audit evidence, that you're supposed to gather to help you do what? Prepare an audit report. So I don't know if there is any question or query up to that particular point, because I would wish to end there. Then, of course, those ones who've joined us, they are very new. There are those who just joined us, they are very new. So I think I've been able to share part of the videos that we've already been able to cover. So kindly go through the videos as you also look at the notes. If you get time, you can be able to print the notes. So these notes are actually very good. They are very good. So if you use them with the videos, then I think everything will be able to flow. Everything will be able to flow because the videos are basically arranged accordingly. So you can be able to print out the notes, go through the notes together with the videos, then everything will actually be able to flow from where we started from the first lesson up to this particular lesson. So I don't know if there's any question up to that particular point. Jen Boogie, do you have a question? Jen Boogie. So those who are new, I've already advised my students, for this particular paper, you need to think like an auditor. Think like an auditor, approach the exam like an auditor. Think like an auditor, approach the exam like an auditor. So that's why in this case, I'll be able to go further and actually try to, for example, explain this is the process as to why it's supposed to happen. This is what we mean by internal control systems. If they are working, this is how you can be able to know they're actually working. If they are not working, this is how you can be able to know they are not actually working. So you need to be able to approach this particular paper as an auditor. Think like an auditor. Approach the exam like an auditor. So I can see Jen says, no, I'm actually okay. Do we have a course outline? So there's a course outline. So you can be able to, I can be able to share it, but the course outline is there. But you don't have to worry, because what we are covering, we'll be able to cover everything that is actually in the course outline. So at RCM, we don't skip what is provided for in the syllabus. So we'll go syllabus wise. Even those areas that are the chances of having to test is almost zero. We still basically go through them. We just go through them because it's part of the syllabus coverage. So we might go through other areas that probably they have never been tested, but it's part of the syllabus coverage. So we'll cover everything in the syllabus. But the syllabus is there. I can be able to share. I'll share with you in the group there. I can see Alpha is asking, we'll be doing sample questions as we progress. I think those who have been in the class since we started, I think we've done some sample questions. So we have like our friend, I don't know who joined, Saum. I think Saum can attest to that. So we'll do them. So, but of course we can be able to cover first of all the whole topic. Then we can go into the questions. We do them. We usually do them. We'll do them. In fact, we'll do so many of them because the trick for this one is to do so many of them so that the student can be able to comprehend as to how they can be able to answer the questions. So by the time we are doing the exam, we'll have done so many of them, especially just from the past papers, so many of them. And of course, this syllabus is not that quite wide, so we'll be able to cover it very fast. And I think we'll be focusing a lot on past paper questions. But I think after each and every topic, we've been able to do some questions. Even the class, was it yesterday? who attended the yesterday lunch hour class? Who attended yesterday lunch hour class? The class yesterday, lunch hour class, I think we did a question. I don't know if everyone has been able to go through that particular revision we did. So the lunch hour class yesterday was purely revision, because there are those who complained that probably they are at work. So if you cover the syllabus during that particular session, they miss out on something. So we just had to do a kind of like a revision. So on those videos that we'll be sending, so there'll be a categorization. There are those class videos covering syllabus. There are those ones that we'll be able to categorize as what? Revision videos. So those ones will just be containing question and answers. So of course, I even have other extra videos I've done for the previous semesters. So maybe I'll be sharing them with time so that you can be able to be using them also to revise for your own benefit, to revise for your own benefit. So after we finish this particular syllabus, this particular topic, we'll go through some of the past paper questions out of from the topic, the past paper questions from the topic. And even the handouts I've sent, I think there are some questions and answers there from, I think, from topic number 7 and topic number 3. I'll also be able to share some questions and answers, I think, from topic number 1 and 2. So they are there. I have them, so you can be able to use them for revision. Use them for revision. So any other concern? 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 William Kamau. William Kamau seems to be very new. William Kamau, do you have any concern? Seems William Kamau is actually okay. If there's not any other concern, then we can end there for today. We can end there for today. So you people can start enjoying the weekend. But I know there are, of course, those ones who are not going to start enjoying the weekend because there is advanced FM after days. There's advanced FM after days. And of course, tomorrow there is advanced FR. So there are those who are doing like maybe 3 subjects. So they still have a long way to go over the weekend. So otherwise, we'll meet some other time. If you have any question or actually concern, you can always post there in the group. I will respond. You can always post there on the group. I will respond. Or you can even reach out to me. I'll be able to assist. So thank you very much for having joined this particular session. We'll meet some other time.